we have what should be an informative week of macroeconomic and corporate news coming up. Top down, the market's attentions are likely to focus on the latest round of economic confidence indicators, also known as Purchasing Managers' Indices or PMIs. In the UK, we've got manufacturing, construction and services on the 3rd, 4th and 5th of April respectively. Remember, these are just surveys, not hard facts, and are indicators of confidence in the future. Generally, any reading above 50 speaks of future growth, any score below 50 could warn of a slowdown, even recession. In March, the results were 54.6 for manufacturing, 52.5 for construction, 53.3 for services. And this chart shows the trend in each since January 2016. Note the pre-referendum vote dip and subsequent recovery, though momentum has slackened a little of late. On the corporate front, the only scheduled news flow from FTSE 100 firms comes in the form of annual general meetings to be hosted by Carnival on the 5th and Smith & Nephew on the 6th of April. A third quarter update from Dunelm on Friday the 7th will provide our latest look into what consumers are doing, but for me, the most likely source of a fuss in the week ahead are the first half figures due from online fashion retailer ASOS on Tuesday the 4th of April. ASOS may be quoted on AIM, the London Stock Exchange's self-regulated junior platform, but it currently has a market capitalisation of £4.5 billion. That would be enough to get it into the FTSE 100 if the company ever chose to seek promotion to the main market. ASOS has bounced back from a torrid 2014 when it coughed up 3 profit warnings owing to a strong pound, a Barnsley warehouse fire and heavy investment in its technology platforms, especially for mobile and international sales. Now the benefits of that international, as well as a weaker pound, shone through in 2016 as the 5-year share price chart suggests. A strong Christmas trading statement back in January helped here too, as the company reported 36% year-on-year retail sales growth for the first 4 months of its financial year. Now, when it comes to the interims, the key numbers to watch are as follows. Total sales growth is the first one. For the full year, ASOS guided in January to a 25 to 30% increase, upgrading its initial expectation of 20 to 25%. Second, within that headline number, watch for the trends in international and UK business. At the 4-month stage, the UK was up 18, international up 36. The UK was lower than expected, international better, and ASOS did describe the UK as a more promotional market. In plain English, that means price competition was hotting up. The figure from international, by the way, was the best for 3 years, even as the company withdrew from the Chinese market. The next thing to watch is gross margin. ASOS suggested this would come in flat for the full year against last year's 50%. Perhaps that reflects the hotter competition here in Britain. Overall, analysts are looking for pre-tax profit this year of around £80 million, up from last year's stated figure of £35 million and the pre-exceptionals number of 62. Finally, the other number to watch out for is capital investment. This is now expected to come in between £150 and £170 million as ASOS invests in mechanising a European distribution centre, upgrading that Barnsley site and also investing in a warehouse in America. The only remaining issue for potential investors is valuation. Consensus profits of 28% growth in earnings per share this year and 22% next sound very beguiling, especially from a company in a sector that's finding life pretty tricky at the minute. But there's no dividend yield and the stock trades on 78 times earnings for this year and 60 times for next. Now that is racy stuff, and those multiples leave little margin for error if something were to go wrong, as 2014 share price plunge attests. So you do need to make sure that ASOS is capable of delivering the growth required to justify that valuation, and then check that the company fits with your overall strategy, target returns, time horizon and appetite for risk. Thank you for watching, and I look forward to seeing you next time.